How does the rise of China, and for that matter, what appears now to be a chronic trade dispute between the United States and China, how does it affect your investment decisions? Does it?
It does. It's almost one of the most important things that we look at. When I taught international trade, it was a theory of comparative trade. And what has happened is basically China was so smart to take advantage of all the trade laws that were written and WTO once it joined the WTO, not just to grow in an unprecedented way, but also to take advantage of it to create an industrial complex that killed the industry in many other countries. Smaller countries, so it's not just, I think the trade issue that President Trump has referred to and is one unifying subject, I think, in the rest of the world is a fact, in the sense that China wants to run the world trade in its way. So that is not something that can go on. Because it's not just the US or Germany or the rest of Europe that is not comfortable, but every small emerging market country that has had its industry or its areas that they had comparative advantage, if we still believe in that, decimated, needs to look at this. And so trade laws and trade rules will get redefined. And again, it's a question of time. So when we look at investment specifically, we have to look at Chinese growth. And one reason we look at China investments, looking at domestic industries that benefit from domestic growth in China, whether it's consumer or tech or education or health, which is one of their fastest growing areas, is because those are not going to get impacted. Doesn't matter how the trade disputes go on, that's where we invest in China.